When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Good morning. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions for you. But of course, the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Good morning, Jeff. How you doing today?
Good morning, Jeff. How are you doing today?
I'm doing great, thank you. May the 4th be with you. It is May 4th already. Can you believe it, Jeff? We are entering, the 5th month of the year. It seems like New Year's Eve was just a few months ago. And tomorrow is Cinco de Mayo. So happy Cinco de Mayo for those people who celebrate that. We hope everybody is having a great weekend. Well, Jeff, let's start the show like we do most times here. Actually, we've done it 99.9% of the time, and that is talking about current events. Earnings season is upon us here. What is your take on that? And also inflationary figures still are not budging at all. What's your take on that?
Well, it looks like the inflationary figures are actually going backwards. They're going worse, not better.
Right.
And, you've got everything from producer price index going up, consumer price index going up, GDP going down. That's not good economically. That's horrible. We've got wages going up 5%, which might sound great if you're, Joe Biden talking at the pulpit. We've raised wages 5%. Yeah, you know what? That just gives people more buying power to overpay for stuff and keep inflation high. It also makes the cost of doing business higher because businesses have to pay more, which means they have to raise prices. So it's basically just a never-ending cycle of inflation. And, I don't see it cooling down at all until they actually, continue to raise rates. And I'm talking short-term rates too. Now, they're still doing some rate-raising techniques like I-bonds going up to 4.25%, I think it was.
Yeah, 4.2%. Yeah.
Okay. Well, if inflation is supposed to be around 2 or 2.5 or 3, and we've gotten it under control, why are they paying an inflation-related bond at 4.25 unless they know it's really at 4.25 or better? Well, here's why. Because if you can get more money on short-term rates at 5.5, if you can buy a 10-year Treasury for paying 4.6. Why would anybody buy an I-bond? But the I-bonds are kind of the only thing that the Fed can sell in order to try to take money out of the economy, which is really what they're trying to do, quantitative tightening. But at the same time, what they're doing is they're giving money back to the banks to buy their own stock and to prop up the market. So it's just really a sham. It doesn't really matter what Powell says. They're trying every trick in the book, and they keep coming up with new ones to make it look like, we're not going to lower interest rates. But guess what? Really? They just raised them on the I-bonds. They're raising interest rates. Raising interest rates are still going up, but it's not filtering into the market because there's so many what we call like the tourist investors who just they're there for the ride and they hear everything what they say on the news and believe it's truth. And good, inflation really isn't out of control, and it seems like inflation's going to go down, and we're really going to have some rate cuts eventually, just not right now. Employment's up, so people are getting hired and they're paying. Well, that sounds good, right? Well, if the news says it's good, then people go, yeah, that should be strong for the market, and so we get some buying in there. But the smart money we're seeing are exiting the market. We're seeing some big turnover lately, last week and the week before, where we've seen some big down days, and rightly so, because I think investors who know how interest rates actually do affect the earning power of companies, which you asked me in the first of your question, and I'll get to in a second, it means earnings are not going to be good. They're not going to be as robust as they expect. How do you pay more? How do you pay 15, 20, 30% more for a stock if the earnings aren't going up, if they're not actually growing? Now, maybe they're growing by revenues just by virtue of the inflation. Revenues, if you're ExxonMobil and gas is at $2 a gallon, you sell X amount of gallons, we'll just, go to the end game here. I know there's refining and all kinds of profit lines in between with exploration and all kinds of other revenue streams. But let's just say if gas is at $2 or $3 a gallon for that same, let's say $2 billion. For every $2 billion in gas you sold last year at $2, if gas is at $4, you're going to double revenues. Does that mean your company is worth twice as much? Well, not if it costs you twice as much or 2.5 times as much to buy the oil in the first place. So it doesn't always equate to profits and earnings growth. And I just used, an example of oil, but we've seen energy trending backwards. I think there was a little bit of fear that this tension in the Middle East was going to cause, oil prices to go up, and it did. But all that really does is filter into make everything else cost more. So inflation, there is no indicator that I can see anywhere that says inflation is getting under control. The only way inflation will maybe get under control, seriously, is do some massive quantitative tightening, which would throw us into recession, which they don't want around an election. But cycles are cycles. They have to happen. As much as I hate the idea of a recession, they've happened for probably eons of time, at least over the last 100 or so years that we can, track the market and so forth. We've seen cycles. Cycles happen. We get a little over exuberant. We overbuy. We overpay for stocks. Stocks, aren't making money because costs of everything go up, and the earnings are mediocre at best. In fact, earnings are pretty much flat for the last couple of years, down 2 years ago, big time, and they've stayed down. I don't see the upside in the market being anything but hype right now. The AI hype has helped it. They've done some trickery from the Fed to try to inject money through banks so they can buy their own stock, do stock buybacks. And considering the fact that mortgage rates are 7% on homes now, who's going to borrow money for a home? Home sales are way down. Builders are coming in late cycle with finishing homes and not being able to sell them now. So there's builders are trending downwards. Builder supplies. Look at Home Depot and Lowe's stock. Those companies, all the ETFs that have builders are getting very soft right now because the economy looks horrible. But there's still that AI hope. There's still 3 or 4 stocks that look like they might make some money. And, they get cheerled beyond belief. I don't understand how anybody who peels back even one layer of the onion doesn't see the fact that there's really not earnings to support it. And back to the earnings question, I think it's funny. I heard on the news, that earnings season's come in so great. 80% of companies are beating their estimated earnings. Well, the estimated earnings for this coming year was about 3.8 last I read a month or so ago, that they expected earnings to come in about 3.8 annualized year over year for the year 2024. Now, last year, the S&P ended up, I think, under 1% earnings growth, yet the stock market's up 20 or 30. So if you pay X for $1 worth of earnings, and earnings are up to $1.01, why would you pay 30% more for that share of stock if there's really not any return or value, especially when you could go buy a 5% short-term bond and have a guarantee from the government, right? So it's kind of counterintuitive that the stock market is still going crazy, other than the fact that, like I've said before, private households own more stock than they ever have. Stock ownership of private households is over 60%, which has only been happened like twice in the history. And that was like right before the crash in 1929, the Great Depression, and also in the dot-coms that turned into dot bombs. And that means, there's kind of a saying out there I heard from, some market guru, and I thought it stuck with me. It's the tourist advisor, the people that are just kind of on the train, just saying, hey, this is a good ride. Let's just jump on and let's just see what happens. There's smart money that's in cahoots with the Fed right now, that's getting money, investing in the stocks that they want to manipulate the market and even manipulate the indexes by buying the Magnificent Seven or the Fab 4 or 5. We're talking about the NVIDIA's, Tesla, which didn't do very well, hasn't done very well lately. Apple hasn't done very well, but Microsoft, Google, Amazon, Meta, done very well over the past year without really crazy growth in earnings other than NVIDIA, which did okay. Microsoft did okay. But if you look at the entire S&P 500, they're expecting a 3.8% increase in earnings. Now, this is earnings that are estimated by the companies themselves. So why would a company that wants to promote their stock estimate that they're going to have 5% earnings growth this year, knowing that it's probably going to be around 4.5? Well, they wouldn't. They'd say, oh, we think it's going to be 3.8, because they know it's going to be around 4.5, so that they can come out and say, look how good we did. We beat earnings expectations. Well, I don't know why anybody's excited about buying into the stock market when the growth is only supposed to be about 3.5%, according to their own estimates, when you could buy a 5.5% short-term treasury with the government with nothing in the near term looking like there's any type of reason that they would lower short-term rates or lower the Fed funds rate or do anything other than try to, sell I-bonds and other things to try to do some tightening of the money supply. But they have to bid up the price of those bonds to over 4% for an I-bond, right? The Fed's really telling us what they know and what they think if we look behind the curtain and see what the wizard's doing. But if we hear what he comes out and says, which is BS, and what the news promotes as BS to try to make, whoever's in the White House, which is really controls the media, at least that party does, we just get all this fake information. So back to earnings. So companies think, oh, we're going to make 3.5% earnings, but they come in now, it's looking like maybe 4.8% is kind of the new consensus based on the first round of earnings that have come out. And if they can continue to beat by the same type of margin, we're looking at 4 or 5% earnings growth during the next year. Well, does that justify 20 or 30% growth in the stock market? It doesn't, fundamentally speaking, to me. But if the government just prints money and you have nowhere to put it and everybody wants to pay more for stock, then I guess you can just be like a tourist investor and just jump on the train and ride and hope it doesn't crash into a wall someday. But when it comes down to it, eventually the balance sheet of the Fed has no more bonds to sell. They have no more money to hand out. And the market goes, oh, You're not feeding me anymore. Well, I'm going to go somewhere else, or I'm going to die. Or you fed me too much, now I have to puke, and it's just going to be, sell-off time, led probably by smart money, including the banks. In fact, they've been selling into this. They've been buying a few stocks, getting everybody hyped to buy all the different stocks in the stock market. And you can find all kinds of really good stocks, or what used to be considered blue chip stocks, that are great short opportunities. In other words, sell opportunities because they're way overpriced. McDonald's has gone down. That's one. We've got, even Costco kind of got a little bit high and is softened up. Home Depot, Lowe's. These stocks that have been kind of the blue chip staples of the stock market are getting sold off and looking soft. I mean, there's sectors in the market that are really looking ugly. Like, it's not just a sector by sector play. There's not a lot of gas left in this market. And I've been saying this since October when they said, we're going to lower interest rates. I'm thinking, I don't see how. There's no way. In fact, they said they were going to lower maybe 3 times. And then all the banks says, we think 4 or 5. And it's like, we think 6 or 7. All they did was hype the market and make all the private households and the dumb money investors jump in the market. And they're just laughing all the way to the bank. They are the bank. So they're laughing all the way to themselves. They're just laughing, going, look at this, man, we're taking profits. Let's just keep it going. Let's keep it going because we can't loan money. Nobody will borrow money at these exorbitant rates. We keep losing money on our credit card debt because everybody defaults. And we can't charge enough fees to overcome that. So let's just buy our own stock, do some buybacks, and let's make some money in the market. Hey, Fed, can you loan us a few $1 trillion? And don't worry, we'll pay you back next March. Well, that's exactly what happened a year ago, March, is the banks were in trouble. And they say, hey, we need some money. We're getting squoze here because interest rates are so high. It's making it hard for us to borrow money and cover our debts and cover our delinquent mortgages. The commercial real estate was getting beat up because of COVID and all that other stuff that was happening. And the Fed says, sure, okay, here's some money. Just pay us back next March 11th of this year was when it was supposed to happen. So some people thought, and I even said, that could be a bad day if the Fed says, hey, time to pay up, you guys are doing good. Well, they couldn't because they can't lower interest rates. Inflation's going crazy. They knew that if they said, hey, banks, you got to quit buying stocks, you need to sell some of that and give us back the trillions of dollars we've given you over the last year or so and pay the debt like we agreed. Instead, the Fed says, don't worry about it. We'll just let it ride. We'll worry about it later. We'll figure it out some other way. And by the way, do you need some more money? We've got the repo fund, which is basically the overnight Fed funds that are available for banks to, make sure their transactions clear. That money just over the last few months has been started to be used for bank transacting their own financial trading business. So banks and brokerage are the same people. They're in cahoots with the Fed. I mean, no doubt about it. And the Fed, of course, is a pawn of whoever's in the White House. So they're trying to prop the market up. But as much as they've done so many tricks and so many shenanigans and lied over and over again, I think not just the smart money, but I think more and more investors are going, wait a minute, this is not really what they said was going to happen. And, we're way up on the market. We're back to even if we, lost money a couple of years ago, maybe a little ahead of time. If we just got in the market over the last few months and have made some money, maybe it's time to take some profits. And if that happens, and if it happens on a big scale, then we're looking at the market tumbling, and there's probably not quick enough intervention available to do that. Because I just cannot see the Fed injecting $3, $4, $5, $6 trillion into the market again to save it from falling because I just don't see how they could do that and quantitative ease by buying that many bonds at a premium from the public in order to inject cash into the system. So I think we're kind of running out of gas. They might be able to juggle a few balls, spin a few plates, and I think they've got too many going right now for the hands that are doing it. But they keep on grabbing a trick out of their bag of tricks. My opinion is, the strategies that we employ to cover ourselves in the face of this really uncertain market, and in my opinion, probably as risky as I've seen it in 30 years. The only time I've seen it probably riskier, and it was obviously riskier, was before they started doing quantitative easing, just such a momentum and a hype play with the dot-coms back in the late 90s. They weren't injecting money in the economy. That was just, manufactured out of thin air by people deciding to take a company public that had no revenues and just put a price on it. And then all of a sudden people had paper wealth and were trading that until it blew up. But nowadays people have gotten used to the manipulation of the market through the Fed tightening and loosening by money supply, basically printing money to the tune of about, $25 trillion since Obama took office. That's a lot of trillions. I think he took office and it was like 7 or 8 trillion in debt. Bush, right before him, took office, I think it was 4, and it went close to 8. And it started just because of the banking crisis. But Obama says, hey, that sounds good. Let's just fix the market and make it rally for the next few years and make me look good. And pretty much the government says, hey, that's a great idea. Look at that. We never look bad because the market isn't even being managed by market forces anymore, or by people deciding what the price of stocks would be. We'll decide. We'll just inject money and tell the banks what to buy and, call it good. So, you can either believe that the Fed is going to continue to prop the market up and that we won't have any corrections And if that's the case, then be a long-term investor that doesn't need to use that money. And again, most of the people that I talk to on this show and in my office are people that are ready to retire or retired already. If you're going to start taking money out of the market, you can't afford volatility. If you're still saving for retirement, I don't care if the Fed's hyping it. I don't care if the Fed manipulates it. It doesn't really matter. Volatility will actually help you. So if you're a long-term investor, meaning you don't have to touch that money for 5 or 10 years, then stay in the market by all means. But if you think that you can squeeze a little bit more blood out of this turnip by staying in the market just a little longer, and you're going to retire next year, and somehow you're going to make a few extra dollars that you'll be able to spend in retirement, I would say start taking some of those profits that you've worked a lifetime for off the table, put them in asset classes that can go up 10 or 12% when the market goes up, but not lose money if the market crashes. Even though the market could go up 20, what if you could still make 10 or 11 that year? Well, that's good. Well, today's interest rates provide those type of things in the indexed annuities. Now, granted, some people are listening to this and say, well, wait, I bought an indexed annuity 4 years ago and it sucks. It's not made me any money. It's been, really low. Well, that's because when you bought that annuity 4 or 5 years ago, interest rates to the companies were like 1%. So they're trying to make you 2 or 3 and feel good about it. Well, now 2 or 3 just isn't enough. Well, now companies can make 4 or 5% on your money. They can leverage it by their buying power as an institution in the marketplace. And they can double or triple your interest from 5% to maybe 10 or 12 or more in some cases. I mean, I don't want to make any promises or suppositions out there, but there are plenty of indexes that are associated with these FIAs, fixed index annuities, that are insured products where you get a fixed principal guarantee. And some of them are, I almost don't want to even say this, up over 20% in just a little over a year. Some are up to 10, 12, 17. I mean, these are numbers from a year ago because of the higher interest rates that are available when the market's going well. So we don't have to be in the market where we could lose, half of our income if the market crashes like it did in 08 or 2000. We could actually make more on our safe money by having that leverage driven on principal protected assets and still make 4 or 5%, net of fees, spreads, whatever, maybe even a little bit more. Plus we've got private equity investments making 8 or 9 or 10 that don't have the risk of the market. So why are we chasing the market just because it's getting overhyped and the TV says so? There's so much more than Wall Street stocks, bonds, and cash that we could go into. And I think a good fiduciary that does comprehensive plans ought to use all of the tools in the toolbox. That's what we try to do. There are ways to still get the upside. If I'm wrong and we're not that close to hitting that wall with the crash and the market keeps getting manipulated and the trickery that the Fed's been using and the White House has probably been orchestrating, continues to go, we still can make a decent rate of return. Now, granted, if you're set up with older products and things like that aren't doing well, then consider upgrading them or consider taking some penalty-free withdrawals out of them and reallocating into those higher interest products. But there are many of opportunities out there. There are opportunities to tweak a plan based on the new higher interest rates and take advantage of some of the safety nets that are out there at the same time.
We're listening to Jeff Bogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our show, of course, is called Premier Retirement. If you like what Jeff has said, if his thoughts resonate with you, you'd like to get in and sit down and have an individual conversation with Jeff to get your questions answered on a one-on-one basis, we are offering this Premier Retirement Roadmap at no cost and no obligation whatsoever. To get yours, call 520-780-9059. I know it's the weekend right now, but you can go ahead and give that number a call, 520-780-9059. It'll take you about 60 seconds to leave your name and your telephone number. Shelley will call you back during the week and set up that appointment for you to sit down with Jeff and get the answers that you need to put you on a path towards a confident retirement. Once again, that telephone number, 520-780-9059. You could also request your plan online at premret.com, premret.com. Jeff, there's the seasonality of the stock market that we've heard about in the past, and one of the seasonal sayings is sell in May and go away, indicating that you sell your stocks in May and then you take the whole summer off. You don't come back until October. Is there really any validity to a statement like that?
There is a tendency to have some market cycles. I think it's been kind of messed up, again, since Obama came in office and started printing money. It's kind of like whenever the money gets printed, it goes up, doesn't matter if it's May or whatever. In fact, there was an advisor that I actually piggyback wrote on with an investment that actually was exactly that. They would just go to intermediate bonds, 20 years ago, of course, they paid 5 or 6%. They'd just be happy making 5 or 6% between May and November and take advantage of the upside. And they were averaging, when the market was averaging maybe, 10 or 11, they were averaging about 15 doing that. There's a period of a few decades where I think that old adage has held up a little bit better than it has lately. I think, in fact, over the last 10 years, it hasn't been quite, it's not like the market goes down. It just doesn't go up as much. I think the average rate of return over the last decade has been like maybe 4 to 6% during that period of time. During the other half of the year, it's probably closer to 8 to 10 or something like that. I don't have the stats in front of me, but the idea is, you can go do something different with your money. Well, when interest rates went down to zero, going off the market because it was only going to make 2 or 3% into something that only makes 1 or 2 was silly. Just let it ride. And so that go away in May and come back in November was kind of a style play that worked when interest rates were higher, where you actually had some place you can make a little bit of money on a guarantee and you didn't have to worry about the downturn in the market. But there wasn't always a downturn or downtrend during that period of time. Typically, if there's a downtrend, it happens kind of at the end of that period of time. September, October seems to be the, historically when the sell-offs, happen. In fact, this last year, we actually had a sell-off from about July to October. So in that case, it worked true to form. It was a bad time to own stocks, and it was a great time to get back in November. I mean, remember they even call it the November to remember. But of course, that was based on, hype and lies by the Fed saying, oh, we're going to lower interest rates. Hey, buy stock. Yes, joking. Tricked you. Thanks for playing. All our broker friends just got big bonuses for ending the year on a big up note. And, they're kind of, like I said, I hate to keep saying they're in collusion and cahoots with each other, but it's got to be a game they're playing together. I mean, they're on the same team on this whole thing, and it's working in their favor, not necessarily. Now, it is working. They might say, oh, the average investor, it's working great for them. Well, yeah, the average investor that has some money in a 401k or in investments that has a little bit of money that's a little bit upper middle class or maybe getting close to retirement where they've saved. But what about the middle class person that's trying to make ends meet and has kids to feed, diapers to buy, and gas to put in their car so they can get to work? Those people are hurting more and more every day while, they hype the market and play these games. So back to the sell in May and go away. I think that's mostly because people on Wall Street, in New York, figure the main hubs of the financial industry is New York, Chicago, London, places that are cold in the wintertime. What do they have to do other than just sit around a computer in a building? Right. Then the weather gets good. What do they want to do? They want to go on vacation. School's out. They want to take trips. They're not at the board trying to do a lot of trading. They're not doing a lot of research for their investors. They're out playing a little bit, kind of letting things ride. And so there's not as much activity and not as much buying pressure in the market because people are taking their vacations. So there's going to be a little less volume just on the buy side typically during those periods of times, for no other reason than people taking time off. And even in my industry, I mean, I do a little less work in the summertime. Actually, I do a lot less work in the fall when I'm hunting. Mm-hmm. That's when I like to do most of my fun stuff and take some time off. There are times when, I'm not, injecting new money into the market necessarily. And I think the May to November is probably a time frame that historically has had less money coming in. But again, when the government prints money goes into the market because somebody's around there having to deploy that money somewhere into some investments, whether it be a bank, a broker, or, some institution somewhere that's getting the benefit of these big dollars that are being injected into the economy. So now they're not injecting money in the economy. Well, they sort of are through the banks. I told you about that earlier, but they're trying to do quantitative tightening and take money out. That's probably going to put some pressure on, the ability to inject a lot more money into the market. But I think they're going to still continue to, fib to us and to fake us out with rumors of rate cuts and rumors of, the economy's doing great. Look at what consumer price index only went up 3.4%. And we thought it was going to go up 3.5. And then next month they revise. They go, oh, whoops, we missed it. It really went up 4.5. But nobody hears about the revisions that always happen. And like 14 out of the last 16 months, I think it's that many, out of the last year and a half, almost every month is revised in a negative way if we're looking at it as far as being helpful to the economy. But if they don't say anything about it, the benefits have been reaped by, the false reports or the not so bad reports, even though I think the powers that be know that they're even worse. And then they keep revising them. And you get the real numbers if you want to go back, but nobody's really worried about the real numbers going back. They want to know what the number is that's going to come out, this week or this last week. Whether the Fed's going to raise interest rates or not, or whether there's just going to say, oh, look we got inflation under control. Shoot, I heard, speaking of inflation under control, I think it was something that JP Morgan said, the only way to get inflation under control is you have to lower interest rates, because if interest rates stay high, then somehow people have to pay more, so inflation is going to be continually being a problem. Well, the thing is inflation's low, it's easier to borrow money, so it actually increases liquidity, which means more people can spend more on things. So while there's a slight argument for it, it doesn't really happen that way in the real world, or economically speaking, and it hasn't certainly happened that way over the last couple of years. In fact, when they started taking money out of the market, trying to curb inflation, which was up at 8 or 9%, annualized a couple of years ago, the market was crashing. And then as soon as they said, oh, head fake, we're really not going to raise interest rates anymore. We're just going to kind of lower them. Let's inject some money into the banking system to help solve the problem, and we'll go on this ride again. Well, that was short-lived. And then they started lying about all the rate cuts that aren't happening. I just don't see how it can happen. I don't see any evidence that makes any rational sense for dropping interest rates other than not caring about inflation, making everybody be able to get money, making these stocks go through the roof. So anybody that has money is going to get richer, and everybody doesn't have money is going to get poorer because they're going to end up being homeless or have to share rent with another family just to afford to rent on their house.
Jeff, hate to cut you off, but we are running up against a break here. Once again, if you'd like to sit down with Jeff and get your no cost, no obligation Premier Retirement Roadmap, call 520-780-9059. Do it this weekend, 520-780-9059. Time for a break, Jeff. We'll be right back with listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Thank you so much for making us part of this early May weekend. This is Premier Retirement with Jeff Hogan. My name's Jeff Shade. We're here for you on the radio about 4 times every weekend, Saturdays at 7 a.m., also 9 a.m. and 1 p.m., and Sundays at 11 a.m. right here on 790 KNST, Tucson's most stimulating talk. And if you've missed any part of the program today, those times are not convenient for you. Remember, we are a podcast. We put each show up on our podcast platform each and every week. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows, or at least many of them, so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions. We've got 3 again this week. Tom's listening to us in Tucson, and Tom writes, if I have a tax-deferred 401k, can I convert it to a Roth IRA without paying the deferred taxes till I roll it over?
Well, unfortunately, as soon as you convert it to a Roth, you owe the taxes. So you could defer them until you owe them at tax time, but there may be penalties and interest for not withholding them at the time of the conversion. So, be careful on that. You might want to consult with your tax guy to make sure that, or girl, to make sure that, you don't get into tax trouble on that. While you're working, it may not be efficient to convert to a Roth if you're in a high income tax bracket. So I don't know if you're, still working. It doesn't really say that, but if you're not working in a low tax bracket, maybe you're living on some already post-tax savings and things like that for a few years, this might be a perfect time to do the conversions to a Roth in order to pay tax at a lower tax bracket before you have to start taking Social Security or start having to take required minimum distributions. Now, I have a spreadsheet program that I just put that's programmed to basically tell us if it makes more sense if you're going to go into a higher tax bracket now, to pay the taxes now so that you don't have to pay taxes later on more money for the rest of your life. The other thing is once you've paid taxes on that conversion, let's say you have $1 million in your 401k and you want to convert half of it and you pay tax on that $500,000, you're going to pay, probably $150,000 in taxes. So that's $150,000 that you don't have to spend unless you have $150,000 sitting in your bank account that you could just pay the taxes with, so you don't have to actually take it out of the Roth. And in that case, it may actually make sense to still go ahead and do it if you're going to defer that Roth for another 20 years before you start spending the money. So as far as your question goes, you can't dodge taxes on the Roth conversion. It's done at the time that it's made is when those taxes become due.
Tom, thanks a lot for sending us that question. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is from Brian listening to us in Oro Valley. And Brian says, I'm interested in dividend stocks as a small source of income in retirement. Are these really worth it as opposed to other stocks? And how is it determined how much the dividend is going to be?
Well, companies can change dividends at will. And there's one company that I see that's always being touted as like the best dividend stock ever. It's actually AT&T. It's been paying about I think the dividend's about 6.5%. People think, well, that's just a ton of money. Isn't that great? Well, about 4 years ago, that stock was trading at $30 a share. Today, it's trading at $17. Well, so the 6% that you're getting in dividends right now only equates to about 3% at a $30 price per share, even though back then they probably paid a 6% dividend on that price per share back then. Well, would you like to lose half of your money? You lose 50% over 5 years, which is an average loss of just simple interest of 10% a year, just so you can make 6.5. I think you have to look at a lot more than just the dividend value. So another one favorite that a lot of people have thought was the greatest thing since sliced bread because it's a great stock and it's a great dividend stock. And it's really not a great dividend stock. It pays about 4% yield. IBM, everybody's known about that one forever. Well, if you look at the history of IBM, in the last 10 years, it is actually down about 10% in the last 10 years. So if you get a 4% dividend, and even if it just was holding even, then you're only making 4%. You can do better on CDs, right? So again, in the last 5 years, that stock's up about 20% in the last 5 years plus 4%. So if you bought it 5 years ago, had a nice little, breakout recently, but it's going back down again. So again, you have to, and I'm just picking stock. I'm not making any recommendations on either of these stocks. I'm just picking two that just recently somebody has come up with me. Well, what about this? This is a great dividend stock. Shouldn't I buy that? Well, a diversified portfolio or an ETF, an exchange traded fund that has, different sectors of investments in it, or even the S&P 500 over the last 5 years has averaged more than that, even if you compound the dividends. So, in 5 years, the, IBM total return is up, 40%, but you could have bought, the index, which would have been, it's roughly up 70 or 80%. So again, it really matters at the end of the day, how much money do you keep? How much money did you actually make? Do dividends give you a reason to hold the stock through a market crash? Well, maybe, but you could just buy more of it later. You could just sell a dividend stock and not take dividends and put your money in short-term interest rates right now at 5% while you're waiting for the market to correct and get to a better value. And then maybe buy those IBMs and AT&Ts at 10 or 20% less than they are right now, and then have some upside potential as well as a dividend. So, having a hands-on approach, gives you a chance to do more than just a passive, well, I just bought a bunch of dividend stocks, let's see what they pay. Okay, well, good for you. I mean, there are some stocks that really hold their own and do pay a nice dividend. The bottom line is, if you buy it for dividends, you're going to hold it, great. Make sure that the stock has stability, the company has some growth potential, good cash flow, good book value. There's fundamentals that we would look at before we start picking dividend stocks. Dividend stocks are different than the hype stocks that we're doing with Apple, Nvidia, Microsoft, and all those. They're just based on what that stock's going to be worth in a year or two, and hopefully we can speculate and make some money. If you're investing in dividend stocks, make sure that the fundamentals support a situation where that company can continue to pay that dividend rather than say, oh, whoops, we haven't made enough money, we can't pay the dividend now.
Brian, thanks for that question. We'll be sending you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Joe listening to us in Casa Grande, and Joe writes, I was laid off in 2021 and officially retired in 2022. We consolidated all of our investments into one account and chose a large investment firm to manage the money. Unfortunately, we've watched our bucket dwindle over the last several months. The firm sends us out regular communications, but we're questioning whether our investments are getting the proper attention. Should we be seeking an advisory firm with a more hands-on approach to client investments? We seem to be stuck on whether to move our investments or stay the course.
I think the bigger the firm, and you mentioned that you went to a big firm, is more likely to have a hands-off approach because they just have like one big giant bucket and they put everybody in kind of the same type of thing. I don't think, based on my experience, I haven't seen a whole lot of custom portfolios, based on going to the Merrill Lynch's, Morgan Stanley's, and JP Morgan's. I've seen that more often in a regional, smaller advisory type firm, like ours that does comprehensive planning. We're going to basically look at things and make sure that we revisit your accounts and build more of a customized plan. You can do that if you don't have 17 million customers and $4 trillion under management. You know what I mean? It's just the economies of scale get actually the best of a big company where they really can't be hands-on because they're not going to trade just your portfolio. They're going to trade the big block of portfolios for those clients that say they have a particular risk tolerance. And you're probably in one of those buckets that, gets reallocated. Now, the other thing that I know about big firms is that they use stocks and bonds. Well, the stock market 2 years ago was, about 10% lower than it is right now, but then it went down about 30% and took a year and something to get back to even and then some. So on 60% of your money, maybe, let's say you had a 60% stocks, 40% bonds, just to have some diversification. So maybe on 60% of your money, you're up 10% in 2 years because you were getting the full value of the index. Now, I haven't seen really any portfolios that's actually outperformed the index. If you have individual stocks, very rarely have I seen that. And I certainly haven't seen it in the last few years because the indexes are weighted higher. They get higher credits for those big Magnificent Seven, Fab Four, Fab Five. The big stocks that are getting all the attention actually are cap weighted based on the size of their company. They get like double, triple, or quadruple credits for $1 in value increase as opposed to maybe a smaller company or a $100 billion company as opposed to a $1 trillion company. So based on that, you've got maybe 10% upside. If you've ridden it all the way down, ridden all the back, okay, you're finally back to even and you're all excited. Now, if you only look at last year, you're doing great, but you have to keep in mind, what's the long-term returns? 2 years ago, bonds were about 20% higher than they are, and guess what? They haven't come up at all. So if you had 40% in bonds that are down 20%, you're down 8% on your bond allocation, and you're up maybe 8 or 10 on your stock allocation. So, after fees, you're about break even in 2 years. And that's about the best case scenario that I'm seeing if people have hung in there. Wouldn't it be cool if you had a product that lost zero money in 2022 and was up 8% last year instead of stocks or bonds. So now you're up 8% in 2 years. And so just like the stock market, you're still up the same amount, but you only made money 1 year instead of down 30 and up 40. Oh, and the indexed annuity products that I always talk about, the fixed index annuities, guess what? The insurance company invests your money in a laddered bond portfolio, but they take the risk. Right now, if they sold that laddered bond portfolio, they would lose money. However, they're getting interest on that money all the time. They're protecting your principal. They're guaranteeing it. They're taking the bond risk off the table for you, yet they get to use that interest and leverage it to where they can make 5, 6, 7, 8, 10% or even more when the market does well. So on our index products, last year we did really well. If you look at the 2023, 2024, so far, it's kind of, the market's been choppy, so we really don't have a good gauge on what it's going to end up on the year, but it started out good. It had a bad April down, gave up a lot of the gains, and I think May is going to be another kind of ugly month. The way it started, I think it looks like we might have another down month. So wouldn't you rather have profits lock in on the good years and not lose money on the bad years, at least on some of your money? And then you don't have to worry about a stock and bond portfolio, both of which, by the way, can lose money. And that's what I think people are really surprised. We're kind of in uncharted territory if you've been an investor for up to 40 years. Bonds never lost money. The interest rates kept on trickling down from, 18% back in the early 80s over the next 40 years down to zero a year or two ago. And now they're starting back up. So now we're like, wait a minute. You can lose money on bonds? We haven't lost money in 40 years on bonds. Well, guess what? In a rising interest rate environment, you can. So bonds now become just as risky, if not riskier, than the stock market. Yet we know the stock market can have a sell-off and lose big money fast. In fact, 50% corrections are not uncommon. I don't think we'll see a 50% correction with bonds unless interest rates go to 10%. The bottom line is, there are alternatives to minimize the risk, not take all the downside, still get some of the upside. And, you probably aren't going to get that on a big box retail investment guy, especially if you don't have tens of millions of dollars where you get all the attention. You get to go meet the guy on his yacht out in the harbor and, get special treatment. You're probably not going to get that type of hands-on from a big, large, well-known firm. You're probably only going to get that from somebody who does comprehensive planning, calls themselves fiduciaries, takes that word seriously, doesn't just say we're a fiduciary, we do better when you do better, and, oh, by the way, we don't do worse when you do worse. Like the people on TV, that's, in my opinion, some of those guys that call themselves fiduciaries really are just big box park and hold investors as well. So, make sure if you do go around and kick tires, just see how comprehensive the planning is, see how often they check, rebalance, how many tools in the shed they'll use. There's a lot more things out there than a stock and a bond portfolio that you just park and hold and wait for. That's what you do when you're working and building assets, for 40 years until you retire. When you're getting ready to retire or retired, now it's time to protect that life's work and to restructure into things that protect your principal, still make money in good times, but more importantly, don't lose money in the bad.
Joe, we appreciate that question. Thank you for listening to us in Casa Grande. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. If you have a question you'd like us to answer on the air, you can send it to us a couple of different ways. You can call it in if you want, 520-780-9059. Shelley will take it down for you. Or better yet, go to premret.com, PREMRET.com. Use the contact page and send us your question. And again, if we use it on the air, we will send you out Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa, where Jordan is manning the fort up there. If you'd like your no-cost, no-obligation retirement roadmap, you want a chance to sit down with Jeff on a one-to-one basis and get your questions answered that you need to put you on a path towards a confident retirement. Again, we're offering this no-cost, no-obligation whatsoever for our loyal listeners. To get yours, 520-780-9059. Make that call this weekend, 520-780-9059. It'll take you about a minute to make that call, but this could be the most important call that you'll make all year because it'll set you up with a conversation with Jeff to get your questions answered on a one-on-one basis. Again, no cost and no obligation for that. You can also request your plan online at premret.com, PREMRET.com. Jeff, every time tax time rolls around every year, some older Americans are very surprised to discover that a portion of their Social Security benefits are taxable. Well, now there's this new bill that's been introduced to eliminate taxes on Social Security benefits. That's right. Make them go away. It's called the You Earned It, You Keep It Act. And that would allow Social Security to keep making all scheduled payments in full through 2054 because, of course, we're scheduled to run out in 2031. It just doesn't seem like it's possible that this is going to work on any level whatsoever. What do you think?
I don't see how it can. They've got way too much invested in it. The liabilities that they owe are so deep. They've got to require people to continue to pay into it in order for it not to even run out 2031 or 2033 or 2032, whatever those numbers are lately. It keeps getting closer and closer. I mean, just a few years ago, they expected 35 was the year it would end, and there'd be less money going in than going out. But now it does seem it's getting closer and closer. Now, if you are under the persuasion that the Social Security Trust Fund is going to run out and you're not going to get your money, some people have done S corps and found ways not to take an actual income from a corporation, leave the money grow there, pay all their bills from it, and you got to talk to your accountant about how to rig this. But you don't have to pay into Social Security, or if you do, you only have to pay one half, not the employer half. There's some tricks you can play. I do not like it, because when I see somebody that had an S corp, maybe they're a contractor, and they said, yeah, I went through life, I didn't have to pay into Social Security, saved all kinds of money on taxes. I says, really? And so now you're not going to get $3,000 a month for the rest of your life. And now you've got less than $1 million and you're supposed to make up the difference on that. That's going to be tough. Instead of where you could have lived, maybe had $600,000 in savings and had $3,000 a month as a base, that $600,000 would have been easier to come up with, maybe another $30,000 or $40,000 a year, and maybe get you to $70,000 rather than not have Social Security. Now you've got to try to get $70,000 off of $1 million. But you have your money. Is that going to really work? I don't know. It's a riskier play. It's a lot more insecure. However, is Social Security secure? I don't know. Some people call it social insecurity.
Insecurity, yeah.
I don't know. So, I mean, it's really up to you to decide. I don't think Social Security, in my opinion, is going to make a big enough difference in my life that it's going to, make or break it. But for many people, it is. And I have a lot of clients that, really rely on Social Security to pay the basics of their bills and are really glad that they put in. Now, so far, it's been guaranteed. That's one of those things that the law and legislation has put into play that says we will print money if we need to for Social Security. Well, that's probably the only thing that I would suggest is probably the only reason to print money, not just to print money just so the stock market could go up. But, if they've made guarantees that you've put money in there, they need to guarantee that money back to you. And if they've mismanaged it or squandered it, then it's their duty to find it somehow. Now, I know how they'll find it. They'll just tax people that they think are rich, or they'll cut Social Security benefits for those that think are getting too much, and maybe readjust for those, the little old lady who lives in a park model that can't afford, making monthly bills unless she has her entire Social Security check and then some. So, I think there's a lot of things that are, that you could say with Social Security that could be a better plan. I just don't think there's a chance in heck that they'll get rid of at least the basics of what they need to at least sustain it for another 6 or 8 years.
Yeah, and I think that for most people listening to the program today that are your age and my age, Jeff, really this is not going to have any effect on them insofar as their Social Security goes. It's still going to be there. But if you're a younger person, let's say you're Jordan's age, your son's age, it very well could have an effect on them. So again, don't worry if you're a baby boomer, something like that Social Security is not going to be there. You called it social insecurity, which is rather interesting because I looked it up while you were talking. The average Social Security check's around $1,770 a month, and that equates to around $22,000 a year. My parents, your parents could have possibly lived on that, but today there is no way possible. Does Social Security generally with your clients, on average, Jeff, make up less than half of what they need in retirement?
My clients do, yeah. I mean, in fact, it's probably less than 30% in general. But most people, if they're trying to make, if Social Security is more than half, then they really don't have any business putting their money anywhere really, other than keeping it safe and living on it, or keep it in your safe money emergency account or something like that, right? So, I think if you look at the population at large, Social Security makes up somewhere between 30 and 60% of a typical. That's kind of within the bell curve of probability that Social Security is going to be 30 to 60% of your monthly nut that you need to crack to pay all your bills. Well, okay, that's great. If it doesn't, then hopefully you have more savings. If it does, then hey, you might be able to build a plan to leave a legacy to your kids, or put some money in a tax-free account that you can use, whenever you feel like, in like a life insurance type alternative, or just tax defer accounts until you need the money for a nursing home in the future, whatever, or buy some real estate and have a cabin in the mountains. But bottom line is, everybody's situation is a little bit different. Some people have learned to live a lot more frugally than others, and other people still haven't learned it and need to. But that's one of the benefits of having a plan, is we figure out what your money will do for you on a realistic basis. And if your budget or your spending plan isn't already below those numbers, then you need to do some tweaking. And honestly, we might not be a fit. I mean, I tell people when they come in, I'm trying to get you to a place where you don't have to worry about money. But I don't want you to put me in a place where I have to worry about your money. because I want to make sure that you have enough that, if your spending plan says you could probably do this, live on $100,000 a year comfortably. Well, don't tell me you need $12,000 a month. That's going to run you out, and that's going to put a lot of stress on me. I'm going to lose sleep over you because I know that the volatility of the market might eat that up. Unless you just had a plan to do that on a very short-term basis and knew that you were going to require or dial it back considerably in the few years, which is fine. If you're in the go-go years, you want to spend more now, that's fine. But again, look at the plan in its totality and make sure that we're not, blowing through it or blowing it up by being a little bit too aggressive on spending. Just like when you were told as a kid, when you grow up, make sure when you get a job, live within your means and save what you can, right? In retirement, you still have to live within your means, unless you know exactly your death date and you can spend every last dime and make it exactly last until that day. Well, good for you. I don't know that plan because I haven't seen anybody's death certificate in advance. Yeah. So, so again, we could just build a plan that gives you a good idea of what makes sense. And if you live within it, then, it might require you to make some adjustments, or you might find, like most of the clients that come in here, find out that if they don't take risks, they can do a lot better than the Wall Street model of 4% rule. If you got $1 million, Wall Street would say you can only take $40,000 a year out of that without, statistically being in a position where you could run out of money in 25 years. Well, there are fixed products that are insured, building your own pension, where you might be able to live on $60,000 or $70,000 a year and still be guaranteed not to run out of money, and very high likelihood that you'll still have money left when you pass. But the best case scenario is if you live to 110 and you use up all your money, those income streams will still be coming in. Well, allegedly. 40 years down the road, it's kind of hard to say what's guaranteed now that will be guaranteed then. But so far, it hasn't changed in the last 100 years on some of the products and the structures that we use. I don't expect it to be changing anytime soon either.
Jeff, I just Googled it here while you were talking, and you can have taxes withheld from your Social Security check. I don't know how much you can have withheld, but you simply file this form. It's a W-4V, voluntary withholding from your Social Security. So that's one way to have taxes taken out of there. But I think really if you take your Social Security check in full and mix that with all of your other income, you might be able to come up with a better tax situation. We're talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Of course, our show is called Premier Retirement. Our telephone number 520-780-9059, 520-780-9059 to request your no-cost, no obligation, no judgment retirement roadmap. Jeff, we offer this retirement roadmap every week. Do you have time for new clients here in the next week or two, or are you all booked up?
Well, we stay booked up about a week or so out, but, people call in, to change things. They find out they got called into work or something like that, or husband got sick or whatever. So just call Shelly. She'll put you on at your earliest convenience. And, she'll ask you a few questions, make sure that initially it seems like a fit for you for the type of things that we do compared to what you want to accomplish. And go from there. But Shelly's the one that keeps my calendar full. And as far as I know, it's always full. I come to work and I have a full day schedule by the time I get here. So I don't really look out to next Tuesday. I have no idea, but Shelly does. So call the office and she'll let you know.
And once again, that telephone number, 520-780-9059 to talk to Shelly to get your retirement roadmap. Again, there's no cost. There is no obligation for this whatsoever. Just a chance for you to sit down with Jeff, talk about your journey towards retirement. The retirement roadmap, by the way, is a 5-point retirement review. Jeff will take a look at your income plan, your investments that support that income plan, also a tax plan, healthcare cost, and estate plan. That is what we call a comprehensive financial advisor. So once again, if you'd like to take advantage of this opportunity that we're offering you this weekend to sit down with Jeff and get all this at no cost and no obligation, call this number. Do it this weekend, 520-780-9059. You can also request your plan online at premret.com, PREMRET.com. Jeff, we are out of time for this week. I want to thank you so much for your time, but most importantly, thank you to all the people here in the greater Tucson area for joining us. For Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.